All right, here's the solution for number 5 on stockholders' equity homework. So we have this stockholders' equity section, and this is all about being able to interpret it. What is the total amount that common stockholders have contributed? So what you have to do is take the common stock par and additional paid-in capital common stock. So here we have 500 in the par value account, 1500 in the additional paid-in capital, 2000. If this were a no par state, you would just need the common stock par. What was the average price per share paid for repurchase of the company's own stock? Well, those are treasury shares. And it tells you that the total cost was 2,400, and there are 200 shares in there. That equals 12 per share. On these questions, go to the nearest penny. 12. All right, on the per share questions, otherwise to the nearest dollar for balances. How many shares are outstanding? Just remember the definition of outstanding is issued minus treasury shares. So issued, it tells you 2,000 minus 200. So in treasury, 2,000 minus 200 equals 1,800 shares outstanding. So only outstanding shares get dividends, only outstanding shares vote. All right, only outstanding shares have rights. A company can't own itself. Okay, the preemptive right of a common stockholder is the right to. One of the things I suggest on multiple choice questions is think of it as 4 true false questions. All right, so the preemptive right of a common stockholder is the right to share proportionally in corporate assets upon liquidation. Well, you recognize this one as liquidation, your right in liquidation. Receive cash dividends before they are distributed to preferred stockholders. That's just never true. So that's just totally wrong. Exclude preferred stockholders from voting rights. Well, preferred stockholders don't have voting rights, so that doesn't really make any sense. And share proportionally in any new issues of stock of the same class. Well, that's it. But hopefully, on some questions, you'll be able to identify that some of the answers, one or more of the answers, are not making sense. Preferred stockholders generally receive the largest amount of cash dividends if the preferred stock is, well, non-cumulative. Anything with non-cumulative, we're going to get rid of. Non-participating, we're going to get rid of as well. So cumulative and fully participating. Common stock dividends distributable are reported on the balance sheet. This would be a tough one. I've said it a couple times. They are in addition to common stock. They're definitely not in addition to retained earnings because retained earnings is its own account. No way a liability, but you may have thought that if you thought of dividends payable. So that's kind of probably the tricky incorrect answer is this one. So we don't create liabilities with stock dividends. I'm not talking about cash or property or liquidating dividends, stock dividends, the pro rata distribution of shares, because we're not transferring an asset. We're only cutting the ownership into more pieces, but everyone has the same ownership, fractional ownership. A reduction of total stockholders' equity, kind of tricky. We do end up debiting it to net it out, but it is a credit balance. So it's an addition. The best answer is it's an addition to common stock. Um, if you had an answer that was an increase to total stockholders' equity, that would also be correct. Um, the addition to retained earnings, well, common stock dividends reduce retained earnings, and the common stock dividend distributable is ultimately transferred over to the par value account, which is an addition to common stock. So that's where it's classified. All right. Number 9, I didn't go over ratios, but here's one that's just so prevalent, I thought I'd throw it in here. ROE is net income minus preferred dividends divided by average common stockholders' equity. And the way you would get this denominator typically is by taking beginning and ending total stockholders' equity and dividing by 2. Additional paid-in capital is not affected by the issuance of no par stock. Stated value acts like par value, so it will increase additional paid-in capital. Preferred stock always has additional paid-in capital, and par value stock affects the additional paid-in capital. That's what's different about it. How would the declaration and subsequent issuance of a 10% stock dividend, this is small, at market, by the issuer affect each of the following when the market value of shares exceeds the par value? Well, if you have any stock dividend, it's going to increase common stock. All right, so it's going to increase common stock through the par account. If you have a large stock dividend at par value, you're still going to increase the common stock account. It's only in this case where you increase also the additional paid-in capital. So another version of this question is with a large stock dividend, then C would be the right answer. Okay, in this case it's D. A corporation declared a dividend, a portion of which was liquidating. How would this distribution affect each of the following? So the thing about a liquidating dividend is that it decreases retained earnings and also a paid-in capital account. So decrease, that's going to happen for every dividend, including the stock dividend. But it must also, to be a liquidating dividend, decrease a contributed capital account. So it could have been this one or this one, but B is the correct answer. Okay, a joint issuance. The amount of the proceeds allocated to the preferred stock should be. So let's see what the allocation is. A lump sum of $125,000. And you know how I'm going to do it. You're supposed to calculate the ratio, but for me, I'm just going to multiply it straight across. The preferred shares, so they issued, dumped my pen for some reason. 5,000 times $18 for preferred over 5,000 times 18 plus 2,500. Times 24 equals, all right, let's do a little work here. 5,000 times 18 is 90,000. So it's 125,000 times 90,000 all over 90,000 plus 2,500. 24 times 2,500, 60,000. Let me just get rid of some zeros. So it's 125 times 90 all over 150. And that should equal 75,000. Yep. I feel like I'm missing something here because I'm getting 75. Oh, I that was stupid. I am missing something. So these aren't. I can't just do it like this. Let me just do it all the way out. $125,000 times 90,000 all over 90,000 plus 60,000, and you got to multiply all that out. You can't just take out the zeros. That was silly of me. It's a plus sign. Okay, and 150,000 divide. I'm just checking 75,000. So there you go. Okay. Now let's go to treasury stock in number 14. Um, they issued shares, they purchased shares, they sold some of those shares. Um, what would be the balance in paid in capital treasury stock? All right, so the first thing to notice is they show you the issuance just as a way of telling you that the beginning balance was zero. Okay? So they purchased the shares at 25,000 or 11 per share. They sell 15 at 13. So that's good. They bought low and then they sold high. So what's going to happen is the journal entry will look something like this on the sale. So they're going to receive cash, which is 15,000 times 13, and they're going to take out treasury shares at 15,000 times 11, because remember, you take them out at cost, and you're going to need additional paid in capital treasury stock, and you can see the difference is $2. So it's going to be 15,000 times 2. Okay, so this is 30,000, and that's where it comes from. All right, if you want to put the numbers in there, you can do the whole journal entry. Let's see, we got 195. So if you're just working the journal entry, 15,000 times 11, that's going to be 165. And then you could have plugged this number. Okay? If they're just asking for the change in treasury or the balance in treasury stock, the easy way to get there is 13 minus 11. 13 is greater than 11 times 15,000. Also equals the 30,000. However, you have to be careful, because if it was purchased at 11 and then sold at 9, there would be zero balance in the paid in capital treasury. You'd have to take some out of retained earnings. The final question. Another little trick that I use for standardized tests. I'm not good at a lot in my life, but I have been good at standardized testing, is look for the question in the question. It can help you weed through red herring information. What effect does the reissuance of the stock have on the following account? So, sounds like another treasury stock question. They issued 100,000 shares. So once again, by giving you the issuance, they're telling you the beginning balance of additional paid in capital treasury stock is zero. They acquired 20,000 at 16. They're using the cost method, so it's not the par value method, it's a cost method. So that's the one we're used to with the treasury stock account. They were reissued at 12, so that's bad. It's not going to affect additional paid in capital because it's below the repurchase price. So it's no effect and no effect. And all 100% of the decrease goes to retained earnings. So, and you could calculate it 16 minus 12 times 20,000. It would be an $80,000 reduction in retained earnings. All right, so that's stockholders' equity homework. Hopefully, if it wasn't clear before, it's clear now.